Well, hello everybody, my name is Bill Cavanaugh and I work with Mutual of Omaha Mortgage. I live in Dublin, Ohio, but I'm always glad to come back to visit Anthony and the crew here. I grew up off of South Hametown Road, went to St. Hilary Grade School, St. Vincent St. Mary High School, and Akron U. So I have Akron through me. So anyway, Mutual of Omaha Mortgage. Mutual of Omaha has been around for about 116 years, one of the most trusted brands in the United States right now. We're going to talk about a different type of mortgage loan program tonight that is designed for people 62 and better. It is called a home equity conversion mortgage for purchase. If you've talked to anybody about it, you may have heard it called HECM for purchase. That's an abbreviation of home equity conversion mortgage. Mutual of Omaha, we do more of these than anybody in the industry. So we have white labeled the name you'll see up in the corner, Lifestyle Home Loan. That is what we call it within Mutual of Omaha. And the reason we changed that is because people would say, what the heck's a HECM? It just didn't make any sense, didn't roll off your tongue very well. Lifestyle Home Loan more describes what the loan is designed to do. And that's to help you if you're looking to buy your final home as you move into retirement or downsize or right size, whatever that is, maybe making an easier transition from your financial standpoint. Does anybody know what the number one concern for people over 65 is? It's not dying. It's not going to a nursing home.
What are you going to pass to your kids?
Retirement.
No?
Money.
What's that?
Outliving your income.
Money. Who said that? Outliving your income. That by far is the number one thing. Do I have enough money saved to live my life like I want to live it? The fastest growing group in our country right now are people turning 100 years old. Retirement, Social Security started back in I think it was in the 40s, 30s or 40s, and it was designed because the average life expectancy for a male was 65. And if you beat that, then Social Security kicked in for you. That's what it was designed to do, is to cover people that outlived their life expectancy. Life expectancies now are in the mid 80s. Women are we die before them on average. I think they're about 86 and men are like 84, 85 is life expectancy. So if you retire at 65, which more and more people are working later than that now, you have to plan for maybe a 30-year retirement. Do I have enough money to live for 30 years and live how I want to live in an area I want to live in? And I tell, we do a lot of education for realtors. A lot of them are not of retirement age. And I'll tell them you have to change your mindset, because our age group, I'm 63, and I'm going to work for a couple more years. We're going from accumulating wealth to distribution of wealth, right? We're no longer contributing to 401k programs or contributing to a pension at work. So money is a huge concern for this age group. Do I have enough money to live on? Who in here wants a mortgage payment when they retire? Nobody, right? I've asked that 1,000 times. Nobody, thank God, has ever raised their hand. So let me set this up for you. We're introducing the Lifestyle Home Loan, or HECM for purchase. It is an FHA-insured loan that is age-based. You have to be 62 or married to somebody 62 to use this program. Or if we've done loans for sisters and they're both 62, that works. So it's an age-based for people 62 and over. It's an alternative to paying cash or using traditional financing. It requires a one-time down payment. We take the age of the youngest borrower, the purchase price of the home, and then current interest rates. I'm praying for 4% again. Current interest rates. We calculate a one-time down payment, and then for as long, and we'll assume it's a couple, as long as either of you lives in that home, you're not required to make any mortgage payment. You're not required to make any mortgage payment. You have to pay your taxes. You have to pay your homeowner's insurance. In a community like this, you have an HOA, a homeowners association fee. You need to pay that. You have to do those if you have no mortgage, right? You got to pay those. And you have to maintain the home. You can't let it fall into disrepair. You do those 4 things, and you'd never have to make a mortgage payment while you're in that home. If you have a mortgage, how many people have a mortgage payment right now? If you think, what would your life be like if you didn't have that, right? It would It'd be nice, right, to have that extra $1,000, whatever the number is, $1,000, whatever. So this is a way to help you do that. Okay, this is a down payment matrix. These numbers are not exact where they are today. This was put together a couple months ago. So this is just kind of show you how the breakdown works. Across the top, we have the age of the youngest borrower. Now, if you're 64 years old, your numbers would be a little different. We just use the representation to go across the board. So in this example, the youngest borrower is 70 years old, and they're looking to buy a $600,000 home. What would their down payment be? You see that other blue block up there? Can you read that? I see people squinting, holding their glasses up. So the down payment would be $397,000. So if you were going to buy if you're 70 years old and you're going to buy a $600,000 home, you put down just under $400,000, and you never have to make a mortgage payment for as long as you live in that home. So you've now purchased a $600,000 home for $400,000. If you were planning on paying cash, okay, let's say you had $600,000, or maybe you could take it out of assets, which people don't want to do because there's tax implications, right? You've gotten in a house that you want to live in a neighborhood as beautiful as this that you want to live, and instead of spending $600,000 on house, you spend $400,000. What did that give you? It gave you $200,000 more to live on, right? It gave you liquidity. People always talk about equity in their house. Equity is a beautiful thing. You can't buy anything with equity, right? You can't do anything with equity. If you want to monetize that equity, you have to sell the house or do a home equity line of credit if you can qualify for one of those. So we've added to your liquidity. We've added the money you can live on. You can do whatever you want with that money, and we have great stories of people that have done all sorts of things with that money that they thought they were going to use to buy a house, and now they have use of it. They've leveraged their money. If you're not living in your dream home, what's stopping you? Somebody chirped it out before, money, right? How many of you were a little surprised by prices on housing when you started looking? Most people, right? I've been in my house 27 years, right? So I'm in this business, so I know these things. I'm out there. But I talk to people every day, and they'll say, yeah, my house, I'm going to clear $400,000, and I'm going to buy something a little smaller that's just as nice. And they can't. You can't do it. It doesn't exist, right? Housing has gotten more expensive just because of the supply and demand we talked about. The Columbus market is similar with inventory. It's better than it was 2 or 3 years ago, but it's still, we can't, down in that market, we can't keep up with the growth in Central Ohio. And there's businesses moving in that just keep putting pressure on housing. And it's hard to believe if you're ever in the Columbus area and you're driving in the northern suburbs, there's stuff being built all over the place, apartments, condos, single-family homes, that's not fast enough. So that is driving the price of stuff up. Price of materials is more expensive. The materials they use to build these beautiful homes is better than what they used when they built your home, right? They're more energy efficient, and they're just better. Cost of labor, construction workers and guys that build home, that cost has gone way up. So let's talk about how you can buy a house these days. The easiest way is to pay cash, right? You buy a $600,000 home, you stroke a check or have $600,000 wired at the title company at closing, and you own that house. So you put out $5,000. The benefit of that is you don't have a monthly mortgage payment. You're not worried about compounding interest. And in that price range, your home is going to appreciate. In this area, your home is going to appreciate. The cons to that, you've taken $600,000 and put it in a house, which is great. You own that house free and clear. But again, that equity, you can't do anything with that equity. You've lost control or flexibility with that money, right? Did some of that $600,000 come out of an asset? Maybe you had to borrow from a 401k or withdraw money from a 401k to get that cash, which can be, again, a big tax implication. The second option is a 30-year fixed. Now that's something we're all a little more familiar with, right? You put 20% down. So in this example, it's a $600,000 home. You put down $120,000. and you borrow $480,000, you have a monthly payment of a little over $3,000 a month. In 5 years, you've paid out $307,370 for that $600,000 house. What do you have 25 more years of? Mortgage payments, right? In the beginning, when you start making a mortgage payment, there's a slide on this later, where does most of that money go? Interest, right? That's how the banks get paid back, right? They front load the interest. In the beginning of that loan, it's pathetic how much goes toward principal and how much goes toward interest. But that's the way it works, right? That's the way people can afford to buy a house. The pros to that, you haven't put $600,000 out, you put $120,000 out, so you have less money out of pocket, maybe gives you more liquidity, maybe keeps some money in assets. You have a fixed monthly payment. We know what that payment's going to be every month, $31.23. So for budgeting purposes, you know what you need to have to put aside. And that's just principal and interest, that payment. Again, we hope your home appreciates. And again, we're in a really good area here. Medina is a well-growing area. The cons to that, nobody wanted a monthly mortgage payment, right? You have a monthly mortgage payment. And maybe you don't do a 30-year fixed at this point. Maybe it's 15 years. But the rationale is still the same. You're paying back all interest for the beginning of that loan. You might as well dump that money out the window. It's gone. That money's gone. So the lifestyle home loan, your down payment would be, and that's even a little better now, between 58 and 68% of the purchase price of the home. So you have no monthly mortgage payment. Again, it has to be your primary residence, so it can't be a vacation home. You have to stay current on taxes, homeowners insurance, homeowners association fees, and upkeep to stay in that home. Our biggest group, we've identified different groups, are our leverage folks. Those are the people that like the fact that they can buy that $600,000 house for $400,000 and they've kept $200,000 working for them. They go back to their financial advisor and say, here you go, can you create an income stream off of this? Can I use it as a down payment to buy a vacation home? Can I put it away for if I need the money in the future for medical expenses or whatever it might be? It gives you leverage over that money that you've lost if you put it all in the house. Let's compare the two loans. This is a traditional mortgage. It's a 30-year fixed mortgage. You borrow $100,000. What do you do every month? Make a mortgage payment, right? Every month you have it withdrawn from your account, you write a check, whatever it is. And over 30 years, you pay that down to zero. So let's say you borrow $100,000. Each month you make that payment. Again, we know where most of it's going in the beginning. It's going toward interest. And over 30 years, you pay off that $100,000. How much do you think you paid back to the bank over 30 years? Yeah, two and a half to three times, so 280 in that range. That's what you pay back to the bank to borrow $100,000. Where rates are today, it's probably closer to 280 to 300,000, right? That's what you pay back over 30 years. So again, while that is disturbing, well, if you think about it, it's the way people can afford to buy a house. Now the lifestyle home loan works a little differently. We're going to start off with a $100,000 mortgage, okay? What aren't we doing every month? You're not making a payment, right? So what aren't you paying us? You're not paying us interest. So the interest is added to the mortgage balance. So the mortgage balance may start off at $100,000. After the first year, it might be $107,000, $114,000. Your home is going to continue to appreciate, okay? So for the first, depending on your age of the youngest borrower, for the first 10 to 15 years, that gap stays the same. Your equity gap stays the same. And in fact, for a lot of people, they gain equity in those first 10 to 12 years. So their equity position stays in a great position for them. It gets added to the loan balance. At the end of the loan, when the last person is leaving that home permanently, and permanently means for 12, the home is vacant for 12 consecutive months. So if one spouse has passed away and the other one has to go to the hospital for rehab or whatever, and it's a 6-month rehab that they have to stay in this facility, nothing happens with the loan. If they're out for 12 consecutive months, it's deemed they're probably not coming back, and then proceedings would be done to repay the loan. We have minimal income requirements. We're not qualifying you to do what? Make a mortgage payment, right? So the income thresholds are much easier to qualify. We have clients that come to us that have assets, but don't have a good income stream. And they can't qualify for conventional financing because it's all based on income. We can dissipate assets. We can say, okay, they've got $200,000 in a 401k. If they need an income, we could draw it off of that. So for a single person, you have to show you have $529 a month of residual income. After you've paid your taxes and insurance and car payments, and there's a calculation FHA has for how much it costs you to live in the Midwest, you have to show $529. For a couple, it's $886. For income, we can use Social Security, obviously, pension incomes. You may still be working. We can, as I said, we can dissipate assets. For most people in this age group, that does it for them. People have gotten rid of a lot of expenses. I see some, I'm very jealous of some of the people we look at because they owe nobody anything. It's crazy. They have no debts, maybe except for a mortgage. We really don't look at debt to income ratios. If you show us that you've got the down payment amount and you meet the qualifiers, you're good to go. You're responsible for taxes, homeowners insurance, HOA fees, and general upkeep of the home. You are on title to the home. This is not a loan where we take the house. You are on title to the home just like you are if you have a mortgage now. You can sell the house anytime you want to sell it. There's no prepayment penalties. We are simply in first lien position, so we're a mortgage on your home. No different than anything you've had. You are fully vested on title, and again, as long as you take care of the house and pay your bills, you're okay. So I know this probably raises a lot of questions. The booklets in the back are available to you. There are 2 inserts in here that are pretty important. The first one, we have webinars, Zoom webinars, every Wednesday at 2 p.m. and 5:30 p.m. Take the time, spend an hour to get educated fully on these. Do it for yourself. Don't tell Uncle Joe you heard about this loan program and Uncle Joe's, oh my God, don't do that. You can jump on these webinars every Tuesday. If you have any questions, if you want me to run numbers for your case, give me a call. We've done a number of loans in this community. We have a lot of very happy home buyers that at first a lot of them didn't think, they thought this was a scam, they weren't doing it, and by the end of the day when they learned about it, it made sense for them. Thank you very much for your attention. Thank you for coming out on this beautiful night.